All right, let's dive into the pulse of the financial world. In the constant whirlwind of market updates and headlines, it's really easy to feel like you're just chasing shadows.
Mm-hmm.
But what if we could cut through all that noise and get straight to the core of what's truly shaping the economic landscape right now?
Well, every market fluctuation, every major corporate announcement, every policy shift, they all tell a deeper story.
Right.
And our mission today is to help you understand those stories, maybe see the bigger picture a bit more clearly.
Exactly. Today, we're doing a deep dive into several recent market developments. We've gathered some significant updates that really show the breadth of what's happening out there, both here and globally.
Yeah, quite a mix.
Our goal is to go through each one, distill the essential insights, and explore the so what behind them for you. So let's kick things off with the big picture. India's benchmark indices, the Nifty and Sensex. Now, based on recent market developments, both saw quite a tug of war this past week.
They really did.
Despite closing higher on July 4th, the Nifty around 25,450 and the Sensex up 193 points to 83,432.8. Both indices still posted, a 0.7% fall for the full week?
That's right.
That signals some real underlying volatility, doesn't it?
It absolutely does. What's noteworthy here is that kind of session where you see that intraday volatility but an eventual recovery. It often points to, strong underlying currents.
Okay.
For instance, the Nifty's daily chart formed what analysts call a hammer pattern, essentially. It's a candlestick shape.
Right, I've heard of that.
And it often signals the market might be bottoming out, perhaps preparing for an upward reversal. It's generally seen as a bullish sign.
Interesting.
So this pattern, combined with key support around 25,300, suggests there's potential for a swift rebound for the Nifty, maybe towards the 25,800 to 26,100 range.
So despite that weekly dip, there's a technical signal that suggests some optimism then.
Precisely. Analysts are advising a cautious sort of buy-on-dips approach, keeping an eye on whether the Nifty holds above 25,200.
Makes sense.
And stepping back a bit, there's also a lot of attention, on the impending U.S.-India trade deal. That could certainly act as another market trigger.
Definitely something to watch. Speaking of individual movers, based on recent market developments, Bajaj Finance shares have definitely been in the spotlight.
Oh, yeah.
The company's stock rose over 3% on July 4th, hit an intraday high of rupees 940.7 per share, its biggest intraday gain in, nearly a month.
Yeah, quite a jump.
And this surge came after they reported strong operational metrics for the first quarter of fiscal year 2026.
Yes, their numbers were robust. For example, their assets under management, or AUM.
Right, the assets they manage.
Exactly. Yeah. That grew a solid 25% year-on-year to approximately rupees 4.41 lakh crore, which is, roughly $53 billion US dollars. Big numbers.
Huge.
They also saw new loans booked rise 23%, and their customer base expanded significantly. It's clear they're operating pretty efficiently right now.
So strong performance across the board. But what's interesting is, even with these impressive Q1 numbers, I noticed Bajaj Finance actually revised its AUM growth guidance for the full fiscal year 2026 downwards.
Mm-hmm. They did.
From 25-27% down to 24-25%. And they also lowered their return on equity, or ROE, guidance. Why would a company with such strong current performance temper its future expectations like that?
That's a great question, and it's a critical point, especially for financial institutions. What's fascinating here is that even when current performance is strong, companies often have to, balance those immediate wins with prudent future outlooks.
Okay.
This revision, which they mentioned back in their Q4 update in April, was influenced by expectations of maybe slightly lower growth in fee income and potentially higher credit costs down the line.
Okay.
Even though they expect stable net interest margins, it just highlights that ongoing balancing act, the projecting future growth in a dynamic financial environment.
So it's about managing expectations and being realistic in an evolving landscape. Makes sense. Now, while some companies like Bajaj Finance are celebrating strong numbers, it's a different story for others.
Right. Not always good news.
Based on recent market developments, Trent, the Tata Group's retail arm, just saw its shares slump over 11%. Big drop. This was on concerns about its growth momentum. What happened there?
Yeah, this is where it gets really interesting for investors. Trent's standalone revenue for Q1 FY26 grew 20% year-on-year to rupees 5,061 crore. Now, on its own, 20% growth sounds pretty good, right?
Yeah, seems solid.
However, what matters to the market is often the rate of growth, especially relative to past performance and management's own aspirational targets.
Ah, the expectations game.
Exactly. That 20% fell short of the company's really impressive 5-year compounded annual growth rate, their CAGR, which was 35%.
Okay, big difference.
And the market reacted immediately. A domestic brokerage firm cut its revenue and EBITDA projections. That's earnings before interest, taxes, depreciation, and amortization.
Right, a key profitability measure.
Yeah. They cut projections for FY26 and FY27.
So it's not just about growing, but growing fast enough for the market. Is that the takeaway?
That's pretty much it. Trent's current growth rate is below its stated goal of 25% annual growth. It just shows how sensitive the market can be to the pace of expansion.
Even if they're still opening stores.
Right. Even if the company is still actively growing its physical footprint, as Trent is, they added, 11 new Zudio stores and 1 Westside outlet recently. But the focus shifts. For you as a listener, this is a great example of how you might try to differentiate between, healthy growth and growth that perhaps just meets past very high expectations, especially when you're looking at a company's long-term trajectory.
That's a crucial distinction. Okay,
Yeah.
shifting to a more upbeat story now. Based on recent market developments, PCJeweller had a brilliant day on the market. Share price zoomed almost 17% intraday.
Huge move.
Yeah. This significant jump was primarily driven by a strong Q1 FY26 business update. They showed around 80% revenue growth during the April-June quarter,
Wow, 80%.
fueled by high demand for wedding and festive purchases, apparently.
Well, what's truly fascinating here, I think, is how effectively PCJeweller seems to have leveraged that period of high-demand wedding season, festive season, while simultaneously executing a serious debt reduction strategy.
Ah, okay. The debt part is key, too.
Absolutely. They've reduced their outstanding debts to bankers by more than 50% during FY 2024-25.
50%.
Yeah, and then further reduced it by about 7.5% just in Q1 of FY26. Their target is ambitious: become debt-free by the end of FY 2026.
That's a serious turnaround.
It is. This dual-focus, strong operational performance and improving balance sheet health often signals a powerful turnaround story for investors. It's not just about the sales.
So they went from a loss to a profit, too, right?
They did. Shifted from a net loss of about rupees 121 crore in Q4 FY25 to a net profit of nearly rupees 95 crore a year later, and a solid full-year profit, too.
Right, the transformation.
It really shows the power of strategic financial management paired with, strong market demand. When assessing a company's long-term health, looking beyond just immediate sales figures to things like debt management and strategic pivots, that can give you a much clearer picture.
Good point. Okay, let's unpack another major market development. Based on recent market developments, shares of Sapphire Foods rallied over 9% intraday.
Another food-related stock moving.
Yeah, this was due to reports that Yum Brands, the owner of KFC and Pizza Hut, is in talks to facilitate a merger between its 2 Indian franchisee partners, Devyani International, DIL, and Sapphire Foods.
Ah, consolidation. This kind of move in the quick-service restaurant segment, especially involving major global brands like Yum, can lead to significant operational efficiencies. Well, think better negotiating power with suppliers, maybe more streamlined marketing, a stronger overall market presence. Yum. Brands is clearly looking to perhaps simplify its India operations.
And the options mentioned were like Devyani International acquiring all franchise rights, or maybe just consolidating all the KFC stores under DIL.
There seem to be the possibilities being discussed.
And the reports even mentioned a potential share swap ratio, something like 1.3. So Sapphire shareholders might get 1 Devyani share for every 3 Sapphire shares they hold.
Yeah, that ratio was reported. And given Devyani International's market cap is nearly double Sapphire Foods, it would be a significant move structuring-wise.
Right.
What's fascinating here is how such a large merger could really reshape the competitive landscape for these popular food chains in India. It could lead to more unified strategies, maybe faster expansion for Yum brands.
So the big question is the ripple effects, right?
Exactly. What ripple effects might such a large merger have on the broader food and beverage industry in the region? For competitors, other franchisees, it's something to watch.
Definitely. Okay, shifting gears now, from corporate mergers to regulatory impacts. Based on recent market developments, shares of Indraprastha Gas Limited, IGL, and Mahanagar Gas Ltd, MGL, both rose significantly on July 4th.
Yes, the gas company.
This followed news that India's natural gas regulator, the PNGRB, approved key reforms to the natural gas pipeline tariff regulations 2025. Sounds technical, but seems important.
It is quite significant, yeah. The PNGRB is basically aiming to create a more efficient and transparent natural gas market.
How are they doing that?
Well, for example, they're reducing the number of unified tariff zones across the country from 3 down to 2. And they're extending the lowest zonal tariff nationwide to CNG compressed natural gas and PNG piped natural gas segments.
So simplifying the cost of moving gas around.
Exactly. It simplifies how much it costs to transport gas. They're also mandating that pipeline operators buy at least 75% of their system used gas. That's the gas needed to power their own infrastructure.
Okay.
They have to buy that through long-term contracts, at least 3 years.
Trying to stabilize things.
Seems like it. Plus, there's this new pipeline development reserve. It's interesting. Half of the net of tax earnings from entities that exceed certain utilization benchmarks will be reinvested into building more infrastructure.
And the other half?
The other 50% gets passed on to consumers through tariff adjustments. So it's trying to balance growth with consumer benefit.
That is an interesting mechanism.
Yeah, it's designed to incentivize infrastructure growth while, keeping consumer interests in mind. By simplifying tariffs and pushing for long-term contracts, PNGRB is likely aiming for more stable gas prices and predictable supply.
So regulation directly impacting companies and consumers.
Absolutely. It's a prime example. And it makes you wonder, how might these structural changes influence India's broader energy landscape, especially the push for cleaner fuels in the coming years?
A lot to think about there. Now, this next story truly grabbed my attention. Based on recent market developments, India's market regulator, SEBI, has banned the U.S.-based trading firm Jane Street from accessing the Indian stock market.
Big news.
Huge. They're alleging market manipulation through positions in India's booming derivatives trade. This feels like a massive statement from SEBI, doesn't it?
It's an incredibly strong statement. SEBI is sending a very clear message. Its surveillance muscle is real. And that even sophisticated trading algorithms used by large global firms aren't immune from scrutiny.
And Jane Street is a big player, right?
Oh, yeah. Global proprietary trading firm, established back in 2000. Over 3,000 employees worldwide. They're significant.
And the core accusation?
SEBI alleges Jane Street Group manipulated index levels in the highly liquid Bank Nifty and Nifty index options segments, basically trying to artificially move the index to profit from their options positions.
Illegally, they claim.
That's the allegation. SEBI's position seems unequivocal. It's not about how much profit was made, but how it was made, the methodology.
And their alleged trading blueprint sounds quite complex. Something about buying aggressively in one patch to push the index up, then reversing, selling aggressively to pull it down.
That's how SEBI described it. Deliberate, large-scale trades designed, allegedly, to create short-lived distortions. And a crucial detail was the alleged use of an Indian entity, JSI Investments, to conduct intraday trading in the cash market.
Which FPIs usually can't do.
Generally not, no. SEBI viewed this as a potential linchpin designed to bypass norms and enable the alleged manipulation.
Wow. And the potential scale of this? SEBI might seek the highest disgorgement amount ever.
That's what's being reported. What's concerning about the allegations from a market perspective is the context. You hear about individual traders losing significant amounts in the options market report suggest around rupees 60,000 crore annually.
Yeah.
During the period SEBI investigated, Jane Street allegedly took rupees 36,500 crore from that pool. That's a huge chunk.
A quarter of the total loss pool, effectively.
Roughly, yes, based on those figures. So for the financial system, this case isn't just about a penalty for one firm. It's about ensuring the markets are perceived as fair and transparent for everyone involved.
Maintaining integrity.
Exactly. Strong regulatory action like this is vital for protecting the average investor and contributing to the overall health and confidence in the financial system. It's about avoiding that banana republic perception in global capital markets.
Absolutely critical. Okay, moving now from specific market events to a major global macroeconomic concern. Based on recent market developments, legendary investor Ray Dalio has sounded a pretty stark alarm.
Yes, I saw that.
Warning of big, painful disruptions due to the soaring U.S. federal debt.
Not mincing words.
No. And this warning comes right after the passage of President Donald Trump's One Big Beautiful Bill, which extends tax cuts, boosts funding for immigration enforcement, but is estimated to add about $3.4 trillion to the nation's already massive $36.2 trillion debt.
The numbers are just staggering. Dalio's projections are quite sobering. He expects the U.S. national debt to rise over 10 years to about 7.5 times the money the government takes in.
Wow.
Reaching maybe 130% of GDP and breaking down to something like $425,000 per family. It's almost hard to comprehend.
And he talked about a debt spiral.
Yeah, he really highlights this risk, suggesting that annual debt service costs, just the interest payments, could balloon from around $1 trillion today to $2 trillion within a decade.
So that forces difficult choices.
Exactly. Which raises the important question, what are these difficult choices Dalio is referring to?
Well, he suggests either a big squeezing out of spending and for unimaginable tax increases, or the other option.
Right, the other option. A lot of printing and devaluing of money and pushing interest rates to unattractively low levels.
That second one sounds pretty dangerous for the economy.
It is potentially very risky. Dalio explicitly warns that printing and devaluing would seriously undermine confidence in U.S. bonds and the broader U.S. credit markets.
That matters globally.
Hugely. He states, quite powerfully, what's bad for bonds and U.S. credit markets is bad for everyone because they really are the backbone of the global financial system.
So what's his solution? Or call to action?
He's calling for swift action to narrow the federal deficit, get it down from the current 7% of GDP to a more manageable 3%. He suggests a mix of spending cuts, tax reforms, and interest rate adjustments.
A balanced approach, basically.
Yeah. But the key takeaway is the urgency. This isn't just about abstract numbers. Dalio argues it's about the very stability of the global financial system that underpins everything. International trade, your savings, investments, everything.
A serious warning. And building right on that, based on recent market developments, the U.S. dollar actually slipped against other major currencies on Friday. This happened as pressure mounted on countries to secure trade deals with the U.S. and, importantly, amidst those rising U.S. debt worries we just discussed, echoing Dalio's concerns.
It's a really complex interplay, isn't it? You've got the dollar index, which tracks the currency against major peers. It was headed for a second straight weekly decline.
And it had a rough first half of the year, too.
Yeah, reportedly its worst first half since 1973. And you can see the impact of trade policy, too. The dollar has fallen more than 6% since April 2nd, when the U.S. announced those sweeping tariffs.
Right.
So what's fascinating here is this convergence. You have fiscal policy, like the rising debt burden, and trade policy, like that looming July 9th tariff deadline, all weighing on the dollar simultaneously.
So even things like strong U.S. jobs data, which came out recently, and typically would strengthen the dollar by pushing out expectations for Fed rate cuts, even that isn't enough.
It seems not entirely. Even seemingly positive news like that surprisingly strong jobs report seems to be getting offset by these larger macroeconomic concerns about debt and trade friction.
The bigger picture is dominating.
It appears so. The dollar's performance isn't just an indicator for currency traders. It really reflects global confidence in the U.S. economy and its fiscal health. And that impacts everything from import costs to the value of international investments.
So it makes you think, how do all these complex interwoven factors actually determine the strength and stability of global currencies? Yeah. And what does that mean for you, in your everyday life? The cost of goods, the value of assets.
Exactly. It's all connected.
Okay, finally, let's round this out. Based on recent market developments, while the dollar faces these headwinds, gold has been on a strong rally.
It's safe haven.
Right. August gold futures gained to $3,368.70, extending its rally to a third consecutive session. What's driving this surge?
Well, what's fascinating here is how gold acts as that classic safe haven asset, you called it, a financial lifeboat, especially in times of economic uncertainty.
So fear drives gold buying.
Often, yes.
Yeah.
The primary catalysts right now seem to be bullish market sentiment fueled by concerns over the labor market and employment. That's driving safe haven demand. For example, the June ADP report.
Yeah, what did that show?
It showed a really shocking loss of 33,000 private sector jobs. That's the first contraction since February 2022. And May's job gains were revised downwards, too. Both point to weakening employment conditions.
So if the economy looks shaky, people turn to gold. Is that the simple version?
That's a big part of it, yeah. Weakening employment often signals a broader economic softening that could lead central banks towards monetary policy accommodation, like lowering interest rates.
Which makes gold more attractive.
Exactly, because gold doesn't pay interest, so when rates are low, the opportunity cost of holding gold decreases, making it relatively more attractive.
Okay.
And stepping back to connect this to the bigger picture, we discuss the U.S. debt, the congressional passage of expansionary fiscal legislation, like that bipartisan consensus to expand the federal debt ceiling by $4 to $5 trillion.
Right.
That also provides tailwinds for gold. This kind of framework characterized by increased government spending, maybe reduced taxation, definitely higher debt limits, it typically weakens the dollar over time.
And a weaker dollar helps gold.
Generally, yes. It enhances gold's relative attractiveness as an alternative store of value. So in this increasingly uncertain economic landscape, it raises an important question. What role might traditional safe haven assets like gold play in protecting value? And how does it react to both economic data and government policy?
A lot going on there. Wow, what a deep dive into these recent market developments. We've really unpacked a lot, from company-specific growth stories and challenges.
Yeah, like Bajaj and Trent.
To major regulatory showdowns like SEBI versus Jane Street, and these huge global macroeconomic shifts with U.S. debt and the dollar.
It's clear that the financial world is just this complex, interconnected web.
It really is.
Indeed. The interplay between corporate performance, regulatory action, national fiscal policies, it creates such a dynamic landscape that truly affects us all, whether we realize it directly or not. The key, I think, is trying to understand not just the headlines, but the underlying forces at play and how they are connect. It really highlights that the more informed you are, probably the better you can navigate this ever-evolving world.
Absolutely. Keep asking those questions. Keep digging deeper. The more you understand these forces, the more prepared you are.
Well said.
And just a reminder for everyone listening, we are not SEBI-registered financial advisors.
That's right.
If you are considering making any investment decisions based on anything you've heard, please consult a certified financial advisor first.